Welcome to the Motor Carriers Insurance Education Foundation in-depth review of coverage addressing the unique operations of a motor carrier. We're going to talk in this session on physical damage coverage consideration. These webinars are not filed for state CE credit and are learning opportunities only. If you need state CE credit, please contact TRS at MCIEF.org for the continuing education opportunities. If you have any questions, please send an email to trs at mcief.org and we'll answer those questions as we receive the emails. Now we're going to look at physical damage coverage. First off, it's first dollars coverage. It's property coverage. First dollars coverage is when the insured pays the insurance carrier a premium to address damage to items they select to be covered. It's protection of the insured's own property or property that they could be responsible for. We'll talk about that. So you're talking about the tractor trailer. It could also address their cargo and equipment, but we're not going to talk about that in this form. So this is why you would need a cargo form to address property of others in their possession, because the care, customer control exclusion. Also called equipment they could have in their possession that you'd want to address, and that could be the forklifts or the front end loaders of things they have, and that would be in marine product. So today we're going to talk about the physical damage coverage found in the standard ISO business auto physical damage coverage form. Insured property to be covered, insured decision. Why not all? And that would be a question you have. Obviously, if they don't have low value, if the insured does not think they will have concerns about the replacement, it's not going to be damaged, then they might not want to do those things. But you need to ask the insured that question. I have found too often that the insured did not want the coverage going in, but they would want it if something damaged. So you need to look at those things. Also, if they don't have everything insured, then you're going to interrupt some of the coverages that were involved in newly acquired items, that part of it, those areas. So you need to go through them. What I suggest you ask the insured is for a list of their equipment every year. It could be tractor trailers and other things, and ask them which one of these do they want coverage on. Where you'll probably find the most places they don't want coverage would be in their trailers. A lot of times those flatbed trailers or the vans are not worth enough in the insurer's perspective. But there is one consideration later that you want to talk about here, is that when a tractor trailer gets involved in a crash, it's going to have to be towed away, and the towing bill will be paid by the physical damage carrier in most cases, and we'll address that situation here later. And if there is no physical damage coverage on the trailer, then your insured would assume part of that towing bill. So that's another reason that they might want to have some coverage on all their equipment that's going to be on the highway that could be involved in a crash, particularly smaller motor carriers. Even though the trailer might not be worth a whole lot, at least they're going to get towing. But they could be required to have it. That's a loss payee. This is a bank interest. And so in those cases, we need to, anytime that you send a coverage out for a loss payee for an item, you want them to have coverage here. Or you have a leasing company, which is PACCAR or Ryder or Hertz or those items where they'll have a loss payee who will actually own the equipment that your insured has. Or there could be some contractual requirements. And again, we're talking about intermodal, trailer interchange, and those kind of things. So this is what you require. Property to be covered. That insures assets, their tractor trailers and other things. And you want them to decide each year, every time we're talking about what equipment do you have, do you want covered or not. And if they don't want covered, then you need to be concerned about the towing bill, particularly those trailers you have here, and they might be worth coverage. You also need to review what might be required to be covered. Again, anybody who's loaned their money, loss payee, anybody who's let them lease or use their equipment, that's the leasing companies, or any kind of contractual obligations. What we have in the auto physical damage form and the motor carriers form or the business auto form for physical damage or the physical damage standalone form, this is actually out of the motor carriers form. This is section 4. In those another section, other forms, there would be a different section, but the same wording. We'll pay for loss to a covered auto. That would have to be a symbol, and the term loss is a defined term, and that would include wrecker services here, or its equipment. Notice the equipment doesn't say attached equipment or its equipment. And we have the actually combinations of two of the three choices: comprehensive collision and specified cause of loss in collision. And so those will be the choices that we have. Most of the policies you're going to write today will be comprehensive and collision combined, in those areas, and we'll talk a little bit about that involved in a second. So standard auto policy. The specialty carriers could be different. You got to look about a Lloyd's of London policy. Their forms could be different. That's an inland marine form, and the difference is they'll have specified cause of loss and collision, not so comprehensive. The equipment that would be added might be required to be listed if it's attached, where the standard auto policy doesn't. And there could be a few more exclusions in it. Mainly employee theft would be excluded, where comprehensive collision or even specified cause of loss in collision does not exclude employee theft. Could be possibly others, and that's an overload where the trailer got overloaded, causing it to crash. In the case of auto liability, that would still be covered when it hits the ground, because then that's a collision with the ground. Those are the things you need to look about, but be aware that there's a lot of inland marine, particularly coming out of Lloyd's. It's an inland marine form, not an auto liability form, auto physical damage form, and we're talking about the standard auto physical damage form here. So auto and equipment, no requirement to be attached. The limit must reflect all the equipment, cab and chassis plus the equipment. And so you need to talk to your insured about what can be added. This is one thing that makes it so different to pick up the proper limit, which we're going to talk about here also before we're through this section together, because all this equipment could be varied. Refrigeration units attached to a trailer. That will could be $30,000. Side kits, those are the 3-foot things on flatbeds that hold the load on. Wet line kits, that's a hydraulic system you find on dumps or cranes or those kind of things. The plow, where a dump truck, where you'll have the plow on the front of that used in the winter on the dump truck to push snow around. In the summer, it's in the yard. It's still covered in the yard in the comprehensive equipment if the insured can prove it's equipment of the units. Tarps, chains, and binders, those are the items that hold the load on in the flatbed up. Any kind of special paint. Auxiliary power unit, this is to keep the driver comfortable to run their computer. They can run from $2,500 to $10,000. You need to go through your insured, even the difference in fifth wheel, where you have a fixed fifth wheel and a sliding fifth wheel. Those are the things that you need to talk about your insured and find out what equipment to add, because every one of those things think dollar signs. So we talk about what the tractor trailer is worth, what the item's worth itself, the cab and chassis, the tractor, the cab plus equipment, the trailer plus equipment, and then make sure we have enough limits added to the items we have to pay for not only the cab with nothing on it, but the fifth wheel versus sliding versus fixed. Those kind of things you need to think about. So you need to go and talk to the insured about how's their equipment, how is their units equipped. Cause of loss, comprehensive plus collision, it's almost all risk. Standard ISO, again, watch specialty company. Specified cause of loss plus collision, there's not much difference with $1,000 flat deductible. This is the unique part that you find in trucking. Most of the times, the trucking industry has a one deductible for all cause of losses. In the standard auto policy, some of you might be coming out of riding smaller units, pickup trucks, even vans, delivery vans, straight trucks, and those kind of things. There could be a differences in the deductible applying to the comprehensive who's not collision, and those kind of things. But in the typical tractor trailer operation, where you have it done by truck specialty underwriters, they're going to write a policy that has a one deductible for all cause of losses, and there's not that much difference than what can happen to a truck between the comprehensive collision and specified cause of loss and collision. This is why most all carriers in this marketplace offer comprehensive collision with $1,000 deductible at least, seeing a few now with $2,500 deductibles. Be aware of those larger deductibles. Most of your smaller motor carriers can't afford much over $1,000 deductible, particularly if you have a tractor trailer involved in it in the same time where you have two deductibles applied. So be careful about choosing the deductible. The only thing that comprehensive collision excludes from the cause of loss is nuclear contamination, wear and tear on the unit itself, and any road damage to tires. Other than that, everything is covered. That's the real advantage in comprehensive collision. The auto policy, the auto that are to be considered a covered auto must meet the definition in the coverage form. That's the truck specialty carriers. They'll use the symbol 7 or 67, specified autos only. So they must be listed. A specified description auto is given in item 3 of the declaration point. So you want to describe it. You should include the year, make, body type, and equipment. This is where you list the snowplow. This is where you list the hydraulic system. This is where you list the auxiliary power unit. This is where you list the equipment, because even though it's covered, you want to make sure it's going to be easy to prove when something damages those items that you meant to cover it. Plus, you want to enumerate them to make sure they're limit. And you want to look at all 17 serial numbers. There's something coming out of the marketplace now. Most the tractors have the 17 serial numbers on them. The first 8 serial numbers are the components. The middle letter is the manufacturer, and the last 8 is the components. You're going to find some where it's legitimate, where they only have 9 serial numbers. They do not have the first 8. Those are things involved in glider kit, and this is in the marketplace today. When you talk about the auxiliary power unit, the electronic lock devices do not apply to older engines, and so you see a few of those glider kits. The problem with the glider kit is it has a new title. It's a new truck with old components in it. So anytime you have a serial number that does not have the full 17 digits, only has 9 digits, then you have a glider kit. But you also want all the digits here. You don't want to just the last 3 or 4. You want to be as accurate as possible, and then go to you can go to some of the VIN decoders to find out exactly what you're dealing with. Autos not owned, could be responsible for. That's hired auto physical damage. Auto leased, hired, rent, or borrowed by the insured, usually on a short-term basis. This is where they would get one from Hertz or Ryder, to temporary substitute. The coverage provided on a primary basis of autos obligations for damage to non-owned autos and their care, custom, control. Those would be not only autos that are power units, but remember, autos include trailers, could be trailers. This is used to provide coverage for temporary substitute for the covered auto. This is when the insured would use a new power unit. It'd be when one of the ones that you have now. The temporary substitute coverage today only covers auto liability to cover the temporary substitute unit. As long as the unit is out of service, then the insured can get another unit to replace that unit, as long as the unit that is covered under the policy for liability is out of service. And as long as it's out of service, that temporary substitute will be a covered auto for liability, but not for physical damage. This is the big gap in coverage now. So you want to cover the physical damage, and this is why you want to have coverage for most all insured you can, hired auto physical damage here. The coverage is primary, but it does not cover auto liability. It does not cover physical damage for owner-operators. The term itself would, but if you go back and look at the exclusion in the policy, back in the other coverage exclusion, which is section 5 of the policy, later you say hired auto physical damage is primary, but autos leased rented with a driver is not covered under hired auto physical damage. So owner-operators' vehicles would not be covered. And this is the item 5 in the form here, which spells out what we just talked about. For hired auto physical damage coverage, all covered autos you hire, lease, rent, or borrow is deemed to be a covered auto you own, meaning primary coverage. However, any auto that's leased, hired, rented, or borrowed with a driver is not a covered auto. So that's the concern you have here. So with symbol 8 and 68 is added to physical damage coverage, then the insurance carrier will provide coverage and have rate and premium shown. Coverage for the insured's obligations for damage to non-owned autos and their care, custom, control. And the coverage is primary, meaning direct coverage. So here's your exposure. Could insured get a tractor out of a dealer's yard without proof of coverage? And also, why would they want to? Typically, again, for a power unit, for a tractor, it would be where they're using owner-operators. That would be, they're using the unit that they have coverage is out of service because it's broke down, it's in for repair, so they got to get one to come and replace it. That's what you typically have. So in that case here, you have minimum exposure because the one that you're writing physical damage from an underwriting standpoint is not on the road. That's the bigger premium that you have, or exposure you have, is when it's on the highway. And so therefore it would not be a concern. And again, you're not going to get it out of the yard or out of the dealer's yard or possession without some, excuse me, not the dealer's, but the rental company's possession without some coverage involved, some proof of coverage that happened. So trucks, especially underwriters, will often not provide hard auto physical damage, but they will provide non-on-trailer physical damage. That's the big exposure you have, because when your insured has trailers, they'll borrow somebody's trailers, particularly flatbeds and dry vans, not often auto haulers, not often tankers, not often reefers, because the value gets too high there. But they'll swap trailers, they'll go borrow your trailer, they'll go rent a trailer, and in those cases, a lot of times the owners of those trailers do not require proof of coverage. And so when you think about hard auto physical damage, the power unit would be covered by the temporary substitute. It fills the gap in the coverage where the temporary substitute has coverage of liability, but not physical damage. It also addresses the concern of the insured having trailers in their possession. However, some specialty truck carriers will not give you hard auto physical damage. I encourage you as a retail agent to seek it. I encourage you as an underwriter to provide it, because again, I don't think you have a problem with power units, because I don't think the insured can get power units out of these rental companies without proof of coverage, and you're really talking about the trailer exposures. So if you want to look at this thing and you write the hard auto physical damage, that is if your insured has power units and trailers for power units, then you want a minimum premium of $100 or something. It can be audited. The insured will not be able to get the power unit out because of the high value without some kind of verifying coverage. So when you send a certificate of insurance in to the rental company, then that will verify coverage. But if the insured has no trailers, then you have to realize all the trailers, there's going to be somebody else's trailers. This is where you have non-on-trailer physical damage. To address that exposure, you need to find out what's the value of the typical trailer. Let's say example for a dry van, that would be about $18,000 a year. And therefore you price it based on if it was listed on the policy as an owned trailer. And so therefore you would probably get a 6% rate. Let's make it simple, 20,000 years, that'd be 12,000. But I'd argue with you that maybe it's not in your possession all the time, so maybe you could reduce that by 70%. So some of your insured don't have trailers. They're people involved in intermodal, or they're typically hauling out of a trailer pool situation like Walmart or Target or things like that. This is where you're talking about in those areas, and this is how you underwrite it. But most every insured you have, particularly the drop and hook and flatbed operations, need hard auto physical damage, or at least not on trailer physical damage, to cover their exposure for having these trailers of others in their possession. You can use CA 9954. This is covered auto symbol designated to manuscript symbols you have here. You'd add it to it. And so you go on item 2, you enter these words or others that back in the symbol here, meet insurance requirement, item 2, that would cover these. And so you would have that change, those kind of wording. And this there, any non-owned trailer while insurance, care, custom control, used by you, responsible for. You don't want attached to, that's too limited. You want used with a covered auto. That would be a concern you could have in here, or you could use a temporary substitute wording. This is kind of a little enhancement. A few carriers used to just have this part of it, and you'll find sometimes temporary substitute covered in the enhancements of policies that we're going to talk about here later in the physical damage coverage. But those any autos you don't own while used in the permission of its owner as a temporary substitute. Those are 2 things that I encourage you to look at providing if you do not have hired auto physical damage that gives you both the temporary substitute coverage for units that are out of service because of being damaged, or where your insured has other trailers in their possession to be used to cover their bailee's responsibility. Standard notice policy, smaller, less valuable units. These are 18-wheelers. That would be original cost new, that you'll, not 18-wheelers, excuse me, smaller units, not 18-wheelers. Original cost new is misunderstood. The premium base is the original cost new, and there's no cap in it. It's the premium base only. So if your insured misunderstands that, there's coverage. I had a case many years ago where I was a consultant for a company, and they wrote a policy, and actually it was in Texas, and they wrote a policy involved, and they had original cost new for a relatively new tractor unit for $20,000. When it got totaled, the actual appraisal was it for $35,000. And the insurance company came back and says, well, it's only listed for $20,000. All we owe is $20,000. Well, I'm sorry. With the original cost new, you owe whatever it is. You have a chance to audit it. And in that case, we actually had a appraisal already done for the damage done, and they had to pay for it. Also had a situation because, and my favorite client, again, the beer company, Mark V Distributors, where we had policies where we had 6 units that Mark V purchased in the last year at the renewal time from Mickey Body Company, including the International Harvester tractors, that were for $25,300 to $25,400. The underwriter, clearly hear me, the underwriter came back and said, Tommy, why don't you give me original cost new for $24,999? Why was that important? Because the gap between the rate was between $25,000 over and under, and we were able to save about $200 a power unit, allowed us to write the risk at nothing to impair the ability to recover. So you have to understand that the insurer doesn't understand that because they don't look at original cost new. I looked at programs that they thought this is what I paid for it. No, it's what you would have paid for it if you bought it new. So anytime you insured buys a used unit, it wouldn't be what they paid for that unit. It would pay for it what was new. I took over a program in Florida when I was a wholesaler a number of years ago, and they moved from being original cost new to being based on the stated amount we're talking about here. And there were numbers of tractors that were grossly under original cost new because the insurer did not understand that, and unfortunately the agent didn't understand the difference in those things, and that insurance company had the exposure. Now you could audit, but how are you going to collect the premium after the fact? That's the concern you have. It's a premium based on it. So original cost new here, it varies in value. It has 5 ages. This year, 3 and 4 years old, 5 or 6 years old, or over 6 years old. 4 base part here. The equipment doesn't have to be listed. It's largely gaps. It's at the time of purchase, even that equipment, not when they paid for it or they bought it, put it on use. Few insurance carriers who write physical damage for 18-wheelers use original cost new. They use something called stated amount. Stated amount, that's limited coverage. It's the premium base. So anytime you see a premium quoted in physical damage as a function of the limit, that's standard property coverage, by the way. Just like you write buildings and equipment. All those policies are written on a stated amount basis where you have the premium based on limit of coverage insured purchases. It could be 4%, 2.5% to 7% here. It's the most recoverable. That's the key here. It's no guarantee of recoverable. Just like all property policies you write have that same provision in it. We base the premium on the limit you tell us, but all we're going to pay in a time of loss is that limit, no more than that. So in setting it up, you never ask the insured how much coverage do you want. You explain to the insured how they will replace the items in real dollars. Ask them what the unit's worth in real dollars to replace the damaged items. Same make, same model, same condition, same age, and something we forget, same mileage, because that's a function also of value. You got to realize this equipment your insured's using, they keep it for a number of years. Typical turnover life is about 7 years, and a typical fleet will rotate their fleets about every 3 to 4 years. The closer you get to 500,000 to 550,000 miles is when the maintenance of the unit doubles. So the closer to that item, the less valuable it is. You could take 2 units out of a yard of a dealership worth $120,000, and you could run them for 3 years. One risk could get $80,000 to $85,000 a year $85,000 miles a year. One could get 100 to 110,000. After 3 years, when you have that 15 to 20% difference in miles per year, you could have as much as 15 to 20% valuation difference, not because of the age, not because of the model, not because of the equipment, because of the miles on it. So particularly if you're insured have lower miles on their units, they typically are worth more than what the marketplace reflects. So you need to carry that in mind. The concern you have is insured wants what they paid for, but what the paid for is the limit. That caps recovery, that doesn't guarantee recovery. Anytime you have an insured who understands that, don't believe them when they said they had no loss, because intuitively you think, well, if I paid for 100,000, I get 100,000. This is where it's difference here, because, and this is also where it's difference in a lot of property coverage. Most of property coverage, meaning the buildings you have, the contents you have, the BOP policies you have, that's played with replacement costs, where you have it based on replacement costs, and that's what the limit would be, replacement costs. Our policy was based on actual cash value, what it's worth in real dollars at the time of loss. The limit's just a premium and a capping. It does not guarantee recovery. So we pay ACV, an amount is scheduled whichever is less. The policy wording for covered auto described in the schedule of physical damage, limited liability is replaced by the following. The limited liability, the most will pay for any loss or damage. The most will pay for any covered auto is the least of the following. The actual cash value of the damage or stolen property at the time of loss. In other words, what's it worth at that time? Not when you wrote it, but at that time. Second is the cost of repairing and replacing. Again, that would be if it's stolen, that's a total loss. And this is where C's added, and this is what's not in original cost new. The limit of liability shown in the schedule. That's the most we'll pay. That's where it caps. We have any adjustment described in it. The appreciation is not a consideration determining actual value in the event of a total loss. In other words, we don't talk about depreciation here. So we would have those kind of things involved in, or we don't pay for betterment either. This is where we have to put new tires on it because they don't have used tires. That could be where the insured could suffer an additional dollar amount they did not recover beyond the deductible if we had to paint the whole unit over and give them a new paint job, or we had to give them new tires and could not give them tires that were half used up. This is where you could have a betterment involved in it. So the unit is damaged. The insured expects money to repair or replace the damaged unit. You want to have all the equipment. What's the value? Is the limit enough? All equipment plus cabin, chassis, and trailers. That's the consideration you want to have and what it would take in real dollars to replace it. There's also an additional cost that we don't think about. The damaged equipment must be removed from the crash site to a safe area. The record services sends the insured a bill. Will the insurance carrier pay the bill or not? Now, the question is, it's covered in the definition of loss, but now the second question, will the insurance carrier pay it or not? And so we have to look at the policy in depth and look at record bills. Why does the physical damage policy cover record bills? That's, again, a definition of loss, and the definition of loss gets back to the protect and preserve provision in the policy. Here is the section 5, the motor carrier's consideration. The following conditions applies in addition to the common policy condition. A, loss condition. B, duties in the event. This ensures duty in the event of loss. C, if there's a loss to covered auto's equipment, you, meaning the insured, must also do the following. Take all reasonable steps to protect the covered auto from further damage. Also keep a record of your expenses for consideration in the settlement of the claim. Notice it doesn't say we're going to pay it, we're just going to consider it. This is the problem happens here. So what happens if there's nothing to protect and preserve? Then do we owe anything in this part of it? Meaning all we do is move it and we don't try to protect and preserve. I could argue that anytime it's in a place not in the insured yard, there's some need to move it from where it is. So that would be a question that you might have. So anytime a record has to be called to move something away from wherever it happens, the crash site or the total site, it'd be paid. You would have the payment of a total bill because they have to remove it from take it out of danger. So the policy states, this is the contract, the most will pay for any accident is limit shown on the policy less the deductible. So the most will pay is the limit. Now what we have here is if it's a total loss and the coverage needs to be able to repair or replace the problem, is there enough dollars also to pay the record bill? Will the physical damage carrier pay the record bill? And this is the gray area because it's not stated. A lot of insurance carriers, and this is where they get this mentality, pay the record bill in addition to the limit. Those carriers are mimicking or using the philosophy or the coverage provided in a standard property coverage. Remember, physical damage is first party coverage. It's property coverage. If you write any property coverage other than auto liability, and some inland marine coverages. You'll find in the standard commercial package policy, any BOP policies you write, in most inland marine policy, it says the protect and reserve, the cost to protect and reserve items is an additional to the limit. And so some insurance carriers will pay the record bill in addition to the limit. So they'll pay the limits out to repair and replace, and record bill is in it. Some carriers will say, okay, we will pay the record bill because that's found in the definition of loss, but we won't pay any more than the limit. That's where it's limited to that. It varies. Some provide a record bill endorsement, and usually that limits it here. If you have one that has a limitation, will you provide more? So you need to ask the insurance carrier here is, do you pay the record bill? No more to pay the limit. Will you pay me more, or is there enhancement? A lot of them put another $5,000 and $10,000 above that if they don't pay the whole amount. So your area exposure as an agent, this is the biggest one, is how record bills are going to be paid. And you need to address that up front. You need to ask the insurance carrier how they pay record bills. Do they pay no more than the limit? And if so, will they offer you more coverage, or their enhancements to pay more than that, or will they pay the record bill in addition to the limit? So those are the concerns you have. So it's a different insurance company's approach. Regulation asks, how do you handle record bills? All paid, no matter what's left to the repair or not. Paid, but no more than limit, only pay a sublimit. And then can you offer more if it's limited? That's your exposure, and you need to find out from your insurance carrier or from your wholesaler when you deliver a policy. Ask that question, because it varies on the marketplace, and different carriers have different interpretation. There's not a wrong way and a right way from the carrier standpoint, because they're trying to limit their exposures, and clearly record bills is a major undefinable exposure that this needs to be addressed, and this is a concern you have because everybody differs. Other consideration, now we have taken this record up, we picked up the tractor, we picked up the trailer, we picked up the cargo, and now it's in the yard. Who's going to pay for that storage? Well, in the case that we deal with storage, you've got involved in it, the actual part of the storage and why the record company can keep the storage is because what in common law is called a mechanical lien. A mechanical lien is when somebody does service to a mechanical item that, which a tractor trailer is, they can retain that possession of that until their bill is paid. This is what we have here. But from the practical part of it, the tractor trailer doesn't deteriorate sitting there. The storage bill might be increased every day. The real reason you want to get out is for the cargo. And so you have this problem now where you have the tractor trailer and cargo, and you have it with different carriers, or unfortunately, you might not have the trailer with any insurance, with any coverage on it at all, because the trailer is not worth much. That's when you have to consider that the insured would have to assume some of that record bill. It's not fair to split a third, because most often large record bills are a derivative of protecting the cargo, not the tractor trailer. So you need to walk away here, and when you have it with two different companies, you need to coordinate those record bills with those two carriers when a crash happens, to get them out of the record bills, out of the towing company's yard, to get the cargo delivered, and then let the two insurance carriers decide later how the bill is going to be split. That should be a part of the cargo consideration, but you need to think about how to handle that. So there's difficulty for truck insurers. 18-wheelers have different considerations than smaller units. They have the added equipment. Value is more of a function of miles than years. How many miles before maintenance? Explain to the insured how a loss will be handled. What is the unit worth in real dollars? Replace it just like it. The damaged items, the lost items. What it takes to have to write your check for with the same equipment, the same miles, the same condition that your insured has. That's got to be the limit. Not how much coverage they want, but you need to determine that. The problem with partial losses is a qualified adjuster here. When we talk about trucks that are worth more than, say, $50,000 and older than 2 or 3 years old, you can't just get a local adjuster here, a local appraiser. They got to be specialized in this big equipment item. Those are probably members of the heavy tractor equipment claims council. There's about 250 of those across the country. There's the major damage to newer units. you got to talk about replacement costs here. You know, we got to repair parts. Do we do original manufacturer? Do you do them off of aftermarket parts? Or to use used parts, which could be used if they are the same like and quality you have here. Those are what the consideration that you have to have. The other thing that's involved in here is, again, what's ACV? Same year and same condition. That's the pre-consideration. Then what's the betterment here? Dollars to put the truck back in the road beyond the deductible for items they cannot be found used, and that's the part here. This is the betterment. This is the tires. This is the major components. If you have to overhaul an engine because the engine got starved of oil, this is the paint. This is original manufactured equipment, or is referred to that. These are things you have to walk through. And the other item here is if it's a total loss. And this is a conflict you'll have, particularly with severely damaged items, because the insured in most cases do not want the truck to be totaled. Why? Because they have a finance contract on it, they have the debt to pay off on it, they don't get any down payment or any equity in the unit if they only get ACV. But the insurance carrier wants it to be closed as quickly as possible. Remember the old adage, the best claim is a closed claim. So the definition of total loss is damage plus salvage. What's the bill to repair it, to put it back, plus the salvage? And that's the big part here, is the salvage. Does it equal or more than what it's worth or the limit? And this is what all adjusters have. And the problem here is how that salvage is handled, because that salvage could be big dollars. In fact, a unit, say, worth $100,000, if it burns up, you probably do not damage the power unit, the power line, particularly the rear axle, the transmission, some of the tires, maybe just the cab. Yet that salvage could be $30,000 or $40,000 to salvage those items. So therefore, the insurance carrier wants to total it, and all it really needs is a cab. So this is a conflict you have. And what's going to be debated often is what the salvage is. The ACV is what it takes to replace it. That's what you're going to find an equivalent part for total losses. The second is to total it, is what the salvage is. And that's a big question you have. And this is why the experienced adjusters that will be involved in, this is where you as a retail agent will be involved in the situation, because they're saying they didn't offer me enough dollars here. I don't want it totaled. I want it repaired. And then giving the insurance company's objective is to get rid of it as quick as possible. That's what's got to be balanced. So here's the recovery problem. Limit to state amount. The limit becomes the maximum amount payable. The insured paid a premium based on the limit, but recovery is based on ACV not to exceed that limit. The value of the autos vary. Appraisals are hard to get. Used values can fluctuate. California, if it's not new, it's not worth more. Today, if the truck has a 1999 engine or older in it, it's worth more than one that's built 10 years later. There's no guarantee recovery by state amount, even when the finance company, leasing company requires a certain amount. This is the last conflict you have here, because the finance company, leasing company says, I need it covered for X dollars. So you put that X dollars in, but at time of loss, the unit is worth less than what's owed on it. That's called a gap. The gap is between what the insurance carrier, what the value of the unit is, and what's owed on it. This typically is only involved in new units, which you have lower down payments in the first 18 months of them being on the highway. Because as we know from your cars and all things, once it gets out of the yard, it loses value immediately, and therefore that's where the gap steps in. And so if you have a lost pay or a leasing company, you want to make sure you have gap coverage. The bank or financial company requires a certain limit to be shown on the declaration page. At the time of loss, insured recovers the lease of the ACV or the stated amount. That is not guaranteed. If the ACV is less than the amount owed, then the bank or the finance company will still not be satisfied, meaning you cannot get a title, meaning the insured still owes money. And so in this case, this is a conflict that you want to make sure you add gap coverage. If it's lost payee or the CA 201, that's the additional insured lessor or lost payee, is required because of the loan or lease, then you want to make sure there's gap coverage. Either in the finance contract or the leasing contract, or add the gap coverage endorsement to the policy, or a lot of your enhancements that you add to the policy will have the gap endorsement. So that's your E&O exposure here, is that the insured think there's enough coverage there, but there's not. Even if there's enough coverage in the limit, it's not. And the note doesn't get paid off. So if you have a lost payee out there, you need to make sure there's gap coverage. What gap coverage says is we'll pay ACV or what's owed on it, which is the most, but no more than the limit. So therefore, the insurer does not get any equity, but at least they get the note paid off. And that's how gap coverage works. The last thing we want to talk about here is your enhancements. We don't look at a lot of these things. Some of them do preferred risk, some of them charge a small premium for it. This is just a list. They all vary. You want a copy of these things. Disappearing deductible, that's an incentive to keep it with the same carrier when you don't have a premium loss. Combined deductible, this is where you have a tractor trailer, and in some cases even cargo, where you have a loss that happens, an occurrence happens, then what is paid is, what's deductible is only one deductible, not three. You can have some personal effect of the drivers or miscellaneous equipment. You have downtime, loss of use, rental reimbursement. That for smaller motor carriers, this is important. This gives them dollars to keep going. This gives them dollars to keep satisfying their customer, keep dollars to hauling loads. This allows them to get money to go out and get another unit to replace theirs while theirs is getting repaired or replaced. Very important. Few carriers put a family attendance to the driver, meaning they fly the attendant out X dollars, $5,000 to fly the family to go out to attend the driver. They build in towing. Again, in addition to limit, they bill in gap coverage, and they bill more than $1,000 for electronic equipment in it. You want to look at these things and find out here. All these could be different consideration, but it needs to be consideration when choosing the physical damage carrier you write coverage with. So here's your checklist. Limit of coverage. What it takes in real dollars to replace the covered auto. Like, kind, and quality equipment, plus the miles on it. Never renew as expiring. You're lazy, you didn't spend time with insured. The value always changes. It could be more. How our record bills are paid, how our gap coverage are paid, and lastly is what enhancements you can buy. We hope you got something. Wrap up then, crash calls by someone else. Again, this could be where the retail agent will want to be involved in the recovery. This is where you can subrogate back. So you want to try to recover the deductible. You want to try to cover uninsured items, like if the trailer did not have physical damage coverage on it and or the equipment they have. You also want to cover the loss of use. So in this case, we have a situation where a third party hurts your insured tractor and cost it. And now you have to coordinate the physical damage coverage that you might have on the policy that will pay, but you also could have a third party to subrogate back and get the dollars for your insured for the things that the physical damage does not cover. Again, loss of use, uninsured items. So you want to make sure to try to help do that. You also want to make sure limits enough to pay for everything. Not enough, then who gets paid first? And this we're talking about here is if the people who did the damage did not have enough limit, then everything will be paid for. But if there's not enough limits, I mean, I had a case where my client got damaged by a insurance carrier by a private passenger vehicle. He only had $50,000 worth of damage. When we total everything up, talking about deductible, loss of use, the trailer had no coverage on it, the tractor had it involved in it. There was recovery. There was probably about $70,000 worth of items damaged. Well, you only had 50. So what we ended up having to do, and what all lost, is the insured gets their recovery first. They get their deductible back, they get the loss of use back, then they get the uninsured items back, and then at that point, the physical damage carrier gets the balance of it to pay for what they had to pay out for. So that's how you want to coordinate that. And you want to make sure that you also make sure you help your insured do those things. That's the end part of this section. We hope you now have a better understanding of meeting the insured's physical damage coverage and their based on their operation. Thank you for attending this presentation.